Owning property through a limited company sounds clever until you realise you've wandered into HMRC's favourite booby-trap maze full of penalties, loopholes and rules that rewrite themselves mid-sentence. Lovely. In this video, I'll show you how to avoid the biggest tax traps people fall into when buying property and how to stop HMRC quietly helping themselves to your profits. You'll learn the truth about mortgage interest claims, stamp duty curveballs, capital versus revenue. Yes, it's a thing, and clever intercompany loan move that's often overlooked. First of all, let's zoom in on one of the most important and misunderstood parts of property ownership: how profit is actually calculated for tax purposes. Now, whether you own your own buy-to-let personally or through a limited company, HMRC expects you to calculate your net rental profit, which is essentially your gross rental income, that's your total rent received, less your allowable expenses. That gives you your taxable profit. But let's break that down for you, as I regularly talk to property owners who just don't get it, and considering the amount of jargon often used, I don't blame them at all. You begin with your gross rental income, which includes rent you receive from tenants, fees charged for extra services such as parking, gardening, cleaning if they're paid for by your tenant, and any non-refundable deposits like cleaning fees or damage compensation. And then you take your deductible expenses from it and start using these to reduce your profit legally. And speaking of expenses, here are some easy allowable expenses you might include to reduce your tax liability. So we've got letting agent fees, we've got repairs and maintenance, we have insurance. Now, whether that's building, landlords or any other, there are service charges if you're paying those, accountancy fees, direct utility bills, admin and travel costs for viewings, inspections, maintenance visits, etc. And crucially, mortgage interest, but only if you're a limited company at this stage. I mentioned that mortgage interest is only a deductible expense if you're a limited company because individuals and partnerships follow slightly different rules. These rules for individuals and partnerships are known as the Section 24 rules and essentially mean that you can no longer deduct the mortgage interest from your rental income. Instead, you get a flat 20% tax credit on mortgage interest paid. So if you're a high rate taxpayer paying 40% or more of tax, this can hugely increase your tax bill as you effectively aren't getting the full tax relief on your cost. Now, this also means that for tax purposes, a limited structure becomes more tax efficient when you've got a larger mortgage or have other income that might be pushing you into the higher tax bracket personally. For example, let's say you've got a buy-to-let property with $16,000 annual rental income and you're paying $10,000 mortgage interest per year. You're a higher rate taxpayer at $60,000 salary and bonuses a year, and you're deciding whether to own it personally or through a limited company. So firstly, option A, personally owned property, which is subject to Section 24. The tax calculation would be something like this. Rental income is $16,000. Allowable expenses, excluding the interest, we'll put at $1,000 just for now for simplicity. So your taxable income is $15,000. The tax due at 40% is $6,000. Your mortgage interest tax credit at 20%, so that's 20% of $10,000, is £2,000. So your final tax bill is £4,000 for the year. Despite only making £5,000 profit, $16,000 rent minus $11,000 interest and expenses, you owe $4,000 in tax, leaving you just £1,000 in your pocket. Ouch. Then we have option 2, owned via a limited company. Now, in a company, mortgage interest is fully deductible from the rental income. So the tax calculation will be something like this. Your rental income, again, $16,000. Your allowable expenses, again, at $1,000, less your mortgage interest at $10,000. Your taxable profit is £5,000. Corporation tax at 19% for small profits, £950. So your final tax bill, £950. That's £3,050 less tax than if you'd owned it personally. Even if you later pay tax to extract the profits, for example through dividends, the overall structure can still be more efficient, especially if you're planning to leave some profits in the company to reinvest, rather than blowing it all on a new kitchen you saw on Grand Designs. As with everything tax related though, it's never just black and white. There are other considerations like whether you're planning to build a full property portfolio or this is your one and only buy-to-let adventure. In other words, is this a proper strategy or just a midlife crisis with bricks and mortar? Your longer-term goals, exit strategy, and appetite for admin all matter, so don't let tax be the only driver. But when it is a factor, choosing the right structure can be the difference between a healthy profit and sending HMRC a lovely little bonus check every January. Now, although I mentioned that limited companies are beneficial for higher rate taxpayers, or if you have a larger mortgage, there are other reasons to own a property through a limited company. If you run a limited company that's built up a healthy cash surplus, but you want to buy an investment property, it complicates matters a bit as all that cash is tied up in your trading company, the one that handles your core business like consulting, e-commerce or services. So here are your two options if you want to buy an investment property. Option one, take the money out personally. You can pay yourself a dividend or bonus or salary, but both of these trigger personal tax liabilities. If you take a salary, you'll suffer income tax at a minimum 20% or more, alongside employee and employer national insurance. And dividends aren't much better. They're taxed at 8.75% in basic rate, 33.75% in the higher rate. That's not to mention the pitiful £500 tax-free allowance per year, which at that amount is hardly worth it. I mean, it wouldn't keep me in Costa Coffee for the year. And this is what you'll be paying on top of your company profits as well. As to take out dividends, you've already had to pay corporation tax. So that could mean you're paying at least 27.75% in tax if you're at the basic rate. Taking out, say, $40,000 could easily cost you $2,500 to $5,000 in tax, depending on your existing income. And that's just to access funds for a property deposit, money that isn't even for personal use. So what's the smarter way? Well, here's where things get clever with option two. Instead of taking the cash out and handing a chunk to HMRC for the privilege, your trading company can simply lend the money to a second company, usually a special purpose vehicle, or SPV for short, set up solely for property ownership. Or if you're feeling wild, maybe you'll call it an ATV. Not because it's tax efficient, just because it sounds like you're going off-road and doing something exciting. What are you up to this year? Oh, just launching an ATV. It sounds a lot cooler than I set up a holding company, doesn't it? But the most important thing here is no dividend, no payroll, no personal income tax. It's just company A lending money to company B, both of which you control. And why does this work? Well, there's no tax on transferring funds between companies as long as both are separate legal entities and not LLPs or sole traders. The loan can be interest-free or interest-bearing, and there's more on that in a moment. The borrowing company, your SPV, records it as a liability and can use it as a deposit or purchase fund. The lending company, your trading company, can record it as a current asset. Moving on, let's break down the absolute mayhem that's property valuation and stamp duty land tax, because it's not just about what it's worth today, it's about knowing which value applies in which tax content. HMRC treats property differently depending on whether you're buying, selling, holding or revaluing. And getting this wrong can lead to overpaying tax, missed reliefs or even penalties. When you're buying a property personally or through a company, you'll be paying SDLT. And no, that's not the abbreviation of my favourite sandwich. SDLT stands for Stamp Duty Land Tax and is far less delicious than a BLT. We'll call it stamp duty for short, and you pay this based on the following. So firstly, the agreed market value if you're buying from a connected party or via a share transfer. The actual purchase price for arm's length transactions. So those two are different. And a question I get asked a lot is, I want to move my personally owned property into a limited company. But it's important to realise this is classed as a sale, and the limited company will have to pay stamp duty on the market value of the property. But that's not all. Oh no, HMRC want another bite of the cherry, as you're effectively selling the property as the limited company is a separate legal entity to yourself. Then you potentially will have capital gains tax to pay in addition, but more about that shortly. So ultimately, you have to do the sums and see if the saving in tax from the company ownership longer term will outweigh the additional stamp duty and CGT you might have to pay. When you eventually sell the property as an individual, CGT, capital gains tax, applies to any increase in value from when you bought it. The capital gain is the sale price minus the original purchase cost plus capitalised expenses, and the sale price used must reflect the actual sale proceeds, so what you actually sold it for, or the market value if it's sold to a connected party or gifted. Your base cost includes the original purchase price, stamp duty, land tax paid, legal and survey fees, major capital improvements, add in a bedroom or a conservatory, for example, and selling costs like estate agent fees and legal costs. So as an example, let's say you bought a property for $250,000. Stamp duty, legal and improvements, they came to $20,000, and you sold the property for $400,000. The capital gain is $400,000 less the $270,000, so it's actually $130,000. If the property is in a limited company, capital gains tax is replaced by corporation tax on the chargeable gains. Basically, the same calculation as the capital gains, just taxed differently and with no tax-free allowance. There's no CGT allowances, there's no fancy reliefs, but you do get to deduct things again like stamp duty, legal fees, selling costs, and the effective tax rate depends on the company's overall profit, usually 19 to 25%. Now, if you want help setting up your property structure properly or figuring out what's tax deductible and what's not, feel free to get in touch. The link's below. Now, capital versus revenue, possibly the most misunderstood concept in property tax. Right up there with, surely this counts as a home office, but getting it wrong can be costly. Like surprise HMRC letter fueled by a regret-fueled biscuit binge costly. So what's the difference? Revenue expenses are your regular day-to-day costs to maintain a property. Think repairs, letting fees, insurance, basically the stuff that keeps the place ticking over without adding bells, whistles, or a basement swimming pool. These are deducted straight from your rental income, meaning less profit, less tax, more sleep at night. Capital expenses, on the other hand, are one-off chunky improvements that add value, extend the life of the property, or turn your boring old semi into a luxury Airbnb palace with marble countertops, voice-activated blinds, underfloor heating that's warmer than your childhood memories, and a mood-lit wine fridge stocked like it's always Friday night in Monaco. They're not deductible from rental property though. Instead, they're added to the cost of the property and only help you later when you sell it and face capital gains tax or chargeable gains through a limited company. It's a bit like putting money into a tax piggy bank that you can only smash open when you sell. But why does HMRC even care? Well, here's where it gets juicy. You might think, if I don't claim the cost now, I'll just do it later when I sell. Same tax relief, different timing. What's the big deal? Well, timing is everything to HMRC. Revenue costs reduce your annual profit, which equals tax savings now. Capital costs reduce the overall gain, meaning tax savings later. So if you sneakily call a capital upgrade repairs and deduct it early, HMRC sees that as trying to fast track your refund like it's Amazon Prime. And they really don't like that. And this is also one of the first things they look at during an inquiry or a compliance check. And yes, HMRC do check. They're especially nosy when it comes to landlords and property companies. They check everything from land registry to insurance lists, and they can even get information from estate and letting agents. So mislabel a new kitchen extension as touch-up painting and you might get more than just a letter. You'll get a backdated tax bill and a brand new folder marked Lessons Learned. So as your accounting ally, I'm going to emphasize these for you again. If it repairs or maintains the property, it's revenue. If it improves or upgrades it, it's capital. And if you're unsure, ask your accountant before you accidentally build a tax time bomb. Let's talk about how you own the property, because let's face it, holding the asset in the right way can be just as important as owning it in the first place. It's a bit like marriage. The paperwork you file determines how much tax you'll pay, who's liable when it all goes sideways, and whether HMRC ends up getting more out of it than you do. Your ownership structure determines which taxes apply, who pays them, what you can claim in deductions, and how you get your profits out, usually while HMRC waits at the door to tax you again. So let's break down the most common property ownership structures, what tax forms you need to submit, and how to avoid stepping on a financial Lego brick. Firstly, the simplest structure is personally held property. This is where you and your other half own the property directly. There are some key characteristics such as rental income is taxed through your self-assessment, your SA 100. You can't deduct mortgage interest in full, thanks to Section 24. You're personally liable for all debts and taxes. Capital gains tax, CGT, applies when you sell. You do get the CGT annual exemption, $3,000 per person in 25-26. And BADR, Business Asset Disposal Relief, is a maybe, but only if it's a furnished holiday let or you're somehow really charming. A structure like this is best for accidental landlords, micro portfolios, or basic rate taxpayers who've not yet been traumatised by Section 24. Then, once your profits start increasing and you're spending more time reading about property tax and watching Netflix, a limited company, usually an SPV, starts to make a lot more sense. SPV, it's a fancy word for a limited company just for property stuff, not to be confused with an SUV, though both will cost you money and need regular maintenance. It's basically a limited company set up with the purpose to isolate financial risk or manage a specific project or asset. The key features of a limited: the company owns the asset, not you personally. You pay corporation tax on profits, 19 to 25%. Mortgage interest is fully deductible. You have limited liability. There's no CGT allowance, but clever structures like share sales can help. For example, often investors will set up a limited per property to then sell the shares and not the property. You don't pay personal tax until you extract profits through dividends, salary, for example. As mentioned, this is the preferred method for building or existing large portfolios, or when your rental properties have grown faster than a tomato plant on steroids. The downside, more admin. You'll now report to HMRC and file with Companies House because apparently one government body peering into your business isn't enough. Then we've got joint ownership and partnerships. If you and a spouse or business partner own a property jointly, either personally or through a formal partnership, the income is split according to the ownership percentages or partnership ratio. And HMRC's rules are married couples, firstly. HMRC's default is a 50-50 split, unless you submit Form 17 with evidence showing different ownership. And the tax filing requirements for those are: for personal joint ownership, you each report your share on an SA 105. For formal partnerships, they also have to submit an SA 800 as well as individual tax returns. And a warning with that, you can't have a partnership between a person and their limited company. That's kind of like trying to partner with your toaster, but you can form a limited liability partnership, LLP, if structured properly. Then finally, for more advanced portfolios, some landlords use a group structure, and you have a holding company, multiple SPVs underneath, each holding a property or portfolio. Profits flow upwards through the company, through the group, or sideways with intercompany loans. You only extract income from the holding company, which makes life neater and a bit more tax efficient. And it's ideal for ring-fencing liabilities or for planning for a sale or for succession. For example, Holding Co Limited owns SPV 1, which has property A in it. It also owns SPV 2 Limited, which has property B in it. Each SPV pays rent or profit into the group, and you only take dividends from Holding Co Limited, simplifying then income reporting. Once again, it does require further administration. However, this one in specifically, we recommend reaching out to an accountant if you're looking to set up. There are risks of anti-avoidance issues. The last thing you want is for HMRC to be raising an eyebrow at you. Can't quite do that. Each SPV makes its own money and pays it up the chain. You only pull cash out of the holding company, like a chilled out landlord at the top, sipping tea and watching everybody else do the paperwork. But be warned, this is advanced territory and there are risks of anti-avoidance issues. Don't go building an empire without speaking to an accountant. The only thing worse than doing it wrong is doing it wrong confidently and getting a lovely letter from HMRC 6 months later. If you want help setting up your property structure properly or figuring out what's tax deductible and what's not, you know where we are. See you next time.